Hi, this is Rob at EminiForecaster.com. I like to periodically conduct tests on what people say they are doing in the marketplace to kind of get a feel for whether or not there's a bias there that can help us in our trading. If you can determine these things scientifically in advance, then you know going into the market whether or not things are stacked up in your favor or against you, because the information that you hear is not always for real. The subject I'd like to cover today is debunking the price gap myth. A morning gap occurs whenever there's a difference in price between the previous day's close and the open in the morning. Theoretically, there's two types of conditions that occur that are like this. A true gap is where the open is above or below the previous day's high or low, respectively. And on a daily chart, and all of our charts here today are provided by TradeStation, this would leave a hole in the chart as you see in the image there. As you can see in the graphic, the high of the third bar and the low of the fourth have a gap which is marked out by horizontal lines. Another case that I believe was coined by Larry Williams is where the open is below or above the previous day's close, but the price is not above or below the previous day's high or low. He called this a lapse, so we'll use that term. On an intraday chart, a lapse looks like this. On a lapse, we can see that the market opened down but not below the previous day's low, as indicated by the horizontal line. The difference between a gap and a lapse is important, though, because a gap is a different type of event than a lapse. A gap takes much more risk for traders to take price outside the previous day's range. As a result, gaps are often driven by more powerful forces than lapses are. It's commonly said, as a rule, that gaps and lapses get covered. And what this means is at some point the market will go back over the area and fill it. Conventional wisdom says more often than not a small gap or lapse will be filled in relatively short order. Further, the conventional wisdom viewpoint says on the day and often the very morning that it occurs, a gap or lapse will tend to be filled. It is also maintained by the majority of traders out there that gaps or lapses of large magnitude can run away and not be covered in the near term. Some traders specialize in this gap area alone and only trade morning gaps and lapses. If these traders are going to be successful at what they do, then the truth about gaps and lapses in general must be known. So let's take a look over the last couple of years and see if we can get to the bottom of this. The graphic we see here shows the equity curve of a simple trading system using one E-mini S&P contract. It buys gaps that gap down, and it sells up gaps without regard to the magnitude of the gap. On an up gap, it'll exit the short position if the gap closes to within the highest of the previous 5-minute bars from the previous day. And if it fails to achieve this at any point during the day, it'll simply exit on the close. Similarly, for down gap, it'll exit the long position if the gap closes to within the low of the previous 5-minute bars from the previous day, and if it fails to achieve this at any point during the day, it'll exit on the close. As you can see, there were about 90 occurrences in this test in the last couple of years of true gaps, and the result of this resulted in a loss. Overall, this particular system was about 48% profitable. And there were periods where doing the opposite could have been very profitable and periods where conventional wisdom held. As a general rule for gaps, then, on this test we have a pretty much random result. Let's take a look at the case for lapse conditions. The rules are the same as noted for the gap test that we did, and trades are only allowed at or before 9:35 a.m. We can see in this test there's about 140 cases of lapses in the last couple of years. And the result of trading according to conventional wisdom would have taken us on a really wild ride. During the period covering somewhere about the first year, it would have lost around $8,000, and during the most recent year, it would have made around $5,000. So this would be only true if you had been smart enough to switch strategies at exactly the right time, which is not a very likely sequence of events. This test also came up about 48% accurate, again showing this approach to be more or less random. What if we were to parse out the gaps according to certain magnitudes of large and small gaps? Let's see what would happen if we did that. As you can see from the optimization grid from TradeStation, the test for only trading smaller gaps did not pan out. Some were profitable and some were not. 3 out of 19 tests were profitable. This confirms that over the last couple of years, gaps are more likely to run than to cover. And bigger gaps are not necessarily more likely to run than smaller ones. The data suggests that a gap greater than 9 points may be more likely to run than gaps of less than 9 points. However, if you look at the distribution, you can see that as the gap size increases, the return does not increase. So conventional wisdom is only partially true, if at all, in this respect. Am I claiming here that trading of gaps has no value at all? No, absolutely not. The trading of gaps can be very viable if managed correctly. For example, our lapse equity curve shows a very strong linear relationship at various times. To improve on this, we might research switching from one method to another based on equity or any number of different ways. One example could be to extract is the case for trading gaps that are more than about 0.5% as runaway gaps. With a little creative thought and a couple of research techniques that I've shown here, you could find plenty of trading opportunities in this exciting area. But if you're a swing trader, it's paramount that you understand how gaps and lapses impact your trading. Typically, this will impact you on entries and on overnight moves. If you're entering short, one of the best things that can happen for you is for the market to gap or lapse up. Worst, of course, is to enter short in a down gap or lapse, because selling at a lower price level increases your risk in a position. If you're already in a position, say long, and the market has a smaller magnitude gap or lapse against you, it's less likely an actionable event when you compare it to a case where you have a large magnitude gap going against you. It's extremely important not to simply take conventional wisdom and act on it without evaluating the turf you're playing on. Doing this can cost you, and it can result in a disastrous trading record. Always research your method before taking the risk of your hard-earned dollars, or enlist a professional to help you achieve the goal. I always welcome your questions at EminiForecaster.com. If you have any questions about this video or trading of gaps, I'm always happy to entertain your questions. You can reach us at the website EminiForecaster.com. I want to thank you for joining me, and all the best to you in your trading.